Okay. Unmute yourself for God's sake. Good morning, everybody. It's the Daily Energy Markets podcast, Wednesday, February the 1st, 10:30 UAE time. We're taking a look at the market open in Asia today, and we're seeing, again, somewhat little change on oil prices, still very much stuck around and on Brent at least, mid 85s, middle of the 80s, up or down each day. We're sort of, again, use the old analogy, in the doldrum, so to speak, which is a sailing analogy for being in an area where there's just no wind. Let's pick up with Clyde Russell, Asia commodities and energy columnist, Thomson Reuters. Clyde, a lot of noise about China's reopening, but as of yet, it's not giving much wind to the sails of the oil markets. Your thoughts?
Well, I think you've got the classic thing of expectations leading the market rather than the reality of what's actually going on. What we've tracked so far for January shows that Chinese oil imports will be more or less exactly what they were in December. So a fairly good outcome, but nothing like an acceleration. Now, there is always a caveat to that. Lunar New Year fell in January, so that might have resulted in a somewhat lower imports than might have been expected. But I think what we're really waiting for is to see if there's actually going to be any uptick. I think the other thing that you've always got to look at is the physical flows always lag by several months. So oil arriving in February was actually bought all the way back in November, sometimes even October. So you've really got to, this reopening thing will take a few months to filter through to actual physical flows. So the paper prices tend to front run the physical flows. But I haven't actually heard a lot from traders who said to me, "Oh, there's a huge uptick in Chinese imports coming, from March onwards." They're expecting them to be relatively strong, but not much more than the current 11, maybe getting up to 12 million barrels a day sort of view.
Let's welcome Henning Gloystein, Director, Energy, Climate and Resources at the Eurasia Group. Henning, it seems, given the lack of drama, if you might say, in the oil price, the oil markets, that the geopolitical risk premium seems to have been drained from the markets. We're not really concerned about the Ukraine war being a challenge to supply at this stage. Your thoughts on where geopolitical risk is in its intersection with the energy markets?
Yeah, so you're right when you said earlier, sort of in the doldrums, and what Clyde just outlined as well. Sort of we're in this stage of generally sort of expecting bit of stuff to happen, but it's not really happened yet. And it's the same with geopolitics. The Ukraine situation has by no means gotten any better. In fact, the conflict in Ukraine has only escalated since it started a year or so ago. But the risk has indeed been sapped out of crude markets for starters, because kind of most of the stuff that's possible to do on the sanction side has been implemented by the West on Russia, but Russia's still sending its oil to Asia. So the next one is fuel. So refined products, on 5th of February, the EU will stop buying shipped refined product imports from Russia. So far, they've been hoarding it. They've been front loading as much as they can. But come a week or so, the Europeans will have to buy this elsewhere. And so we do expect some dislocations to happen in that space, because the Europeans will have to buy refined products from places where they usually don't buy it, and that will take it away from other buyers who will then have to shift and buy it from somewhere else. So this will muddle up the market. We expect premiums to be impacted by this, but we do not think there will be a severe immediate shortage of refined products. I know a lot of people fear this, but we actually have some faith in the oil industry there. They're quite capable to adjust to new situations. So we think this will happen again.
Let's welcome from Venezuela, Jose Chalhoub, political risk and oil analyst. Jose, the surprising headlines that I'm seeing out of Venezuela is PDVSA toughening the terms for buyers after a month of long haul to most exports of crude and fuel. Can Venezuela afford to be so strict on payments? What's the story behind the story?
Yeah, thank you, Sean. Well, there was a change recently in the PDVSA top authorities. We have a new PDVSA president, where he started to change and put all the contracts under review. and decided to move ahead with this new decision and change the terms of payments and demanding prepaid, all cargoes in exchange for services and goods. Watching how the Venezuelan economy can just move ahead. We're still stuck with the same problems with the sanctions and all this, despite the recent moves by Chevron getting this new license. But well, this was kind of expected move by this new authority, demanding this new method of payments. But the challenge for PDVSA will be to ramp up production. Recently, Chevron told different news media that it got to lift up production of Venezuela by about 40,000 barrels per day. But this will be the most important thing will be to see if this will be sustainable, and in the coming 5 months where this new license will expire.
Clyde, the story in China, I was enjoying reading your column this week, where, I mean, the idea of Asia diesel profit margins are on a decline with Chinese exports, but you're signaling that may about to change. Where is the whole China export of products? I mean, we heard just there some comments from Henning indicating the world will sort out this products problem. Will that be the Chinese solution? Where is that narrative at the moment?
Well, it's kind of interesting because, again, we're in that sort of period of uncertainty. What we have seen, what we know for a fact, is that Chinese exports of products, especially diesel, but also some gasoline and jet fuel, has been going up, and they've done that from the fourth quarter onwards. They did that really because they wanted to stimulate their economy. It was a cheap, easy way to stimulate their economy, buy in crude, sell higher value products. Asian refining margins were massive at the time. You had record highs for diesel. Those have come off with the entry of China back into the market in force. We will expect to see a slight decrease in Chinese product exports in January, but again, we expect them to accelerate. So what we've really got is this whole idea that China is your swing refinery for the world, and they are able to ramp up production and export. They might continue to do this as long as the margins remain in their favor. Right now, what China's doing, and India, you've got to remember, India is also a major exporter of refined fuels. They're buying in really cheap Russian oil. What we're actually looking at is Russian exports into Asia hit another record high in January, some 700,000 barrels a day, more than what they were in December, which was the previous record high. So what you're really getting is Russian crude is coming in and being refined and then sold out. The problem comes when Europe stops buying Russian products. Can we then, sort of swing that around? Russian products won't have a market in Asia, not much, maybe a little bit into Pakistan and some countries like that. But Asia's biggest buyer of products, especially diesel, is Australia. They won't be buying Russian products directly, although they buy fuel made from Russian oil just in Chinese or Indian refineries. Weird, but anyway, that's how it goes. So you've got a problem with the sort of how the flows are going to work. Because I don't think the Russians will be able to sell all their products, especially if Europe really does stick to not buying the products. They won't be able to come to Asia. The crude can come to Asia, but then you've really got to ramp up your refining processes in Asia, which means the Chinese are going to have to keep, exporting. I think they will do that because there's money to be made. But, again, it's not something that's absolutely certain.
Henning, as we sort of sleepwalk a little bit away from the geopolitical risk in the energy markets, with Ukraine sort of being stuck in this sort of midwinter stillness, but all of the weaponry building up for an explosive spring, including the famous Leopard 2 tanks now. I never knew I'd even know the names of German tanks, but I do. They're called Leopard 2s, and everybody apparently has them. They were like a Mercedes. They're great, and they're on their way to the Ukraine front lines. But meanwhile, in another quiet corner of Central Asia, the International Crisis Group has ranked Nagorno-Karabakh as the second after Ukraine among the top 10 conflicts to watch in 2023. Not number 10, not number 20, number 2 on the wars to watch. And the same group of characters, Russia, Iran, Israel, world powers. Nagorno-Karabakh, of course, is the Armenian enclave within Azerbaijan that Azerbaijan is determined to strangle to death. How big a challenge is this? Should we be paying attention, or just noise on the sides?
No, we should definitely be paying attention to potential wars or armed conflicts flaring up in different regions of the world. And this is one of the many associated or sort of side risks of the war in Ukraine, is that the world attention is totally, well, it's absent for the rest of the world. Now, the one of the reasons why Central Asia doesn't stand that high on the attention list of the rest of the world is because it doesn't impact the rest of the world so much. Ukraine is directly on the border with the EU and NATO, and Russia is directly involved, and the West is, you can indirectly involved, but increasingly more so with all the Leopards that you mentioned, and different military equipment. But that still doesn't matter. I mean, if wars flare up in different regions, this is a major problem for people locally. Obviously, it's their livelihoods, but the economies around the world and everyone involved. And this is not the only one. The Balkans seems to be flaring up a little bit as well. You mentioned Iran, so the Middle East isn't exactly going well at this stage either. I mean, let's face it, China, Taiwan seems to be. It's we don't actually expect a war this year, but the rhetoric isn't going well. And there's still ongoing problems in South America as well, not on the geopolitical scope, or scale, but there are issues, and they're all not receiving the attention that they should be, because everyone is so focused on the war in Ukraine.
Well, one of the big issues here in this region of Azerbaijan, Armenia, is the potential that Azerbaijan would block the connectivity between Armenia and Iran, and essentially remove also Russia's connection. There's some very big actors vested in this conflict. So certainly and as I said, in this instance, recognized as the number 2 on the list of potential flashpoints for the year ahead. But looking to South America, Jose, I wanted to get your thoughts as we go into the era of Lula is back, and we had the German Chancellor visiting with the new Brazilian president this week, and Lula, the Brazilian president, was somewhat dismissive of European concerns about Russia. What's the view there, do you think, and where should Europe expect South America to stand on the issue of the Russia-Ukraine conflict as it goes into year 2?
Yeah, sure. And it's pretty interesting, the momentum of this visit by the German chancellor, trying to get some deals on lithium, knowing that, for example, we have Bolivia here as one of the top reserves of lithium in the world, also in Chile. So South America, as we have spoken before, it's one of the top region exporter of commodities in the world. And for Europe, as speaking and talking about oil and gas and other commodities such as copper, zinc, silver, lithium, you name it, it's going to play a key role in the middle of this war in Ukraine. But it definitely has to sort out all this different political turmoil unfolding in different key countries, such as in Peru, for example. Peru is still in the middle of ongoing protests against the president Boluarte, for example, that sacked the former leftist president Castillo, that it's impacting in some way the commodities exports in the country. We have the situation, still uncertain situation in Brazil, that it's in some ways it's going to impact the operations of Petrobras after the naming of a new CEO of the company. and knowing that it has to deal still with the fuel prices problem that it's been impacting the company in the last years under former President Bolsonaro. And, and in Colombia, after Gustavo Petro said that there won't be any new oil exploration in the country, and we have the new kids on the block, such as Guyana and Suriname, for example. So to sum it up, the region has to sort out this different political risk unfolding in these different countries to finally take advantage of this Chinese reopening in terms of, commodities exports.
Clearly a big opportunity for Latin America if China does indeed fully reopen. Clyde, your thoughts today? Of course, OPEC Plus has its bi-monthly JMMC meeting. Your thoughts on the outcome from that meeting? Should OPEC Plus be looking at the reopening of China, their biggest customer, and release some more barrels that they shut in at the end of last year?
Yeah. I don't think there's going to be any change at this meeting. I think we're going to stick to where we were. I think the thing that I look at when I look at OPEC and the wider OPEC Plus group is how much are they actually producing and how much are they actually exporting? Because it looks like again they fell well short of their targets in January. Reuters is reporting something like 920,000 barrels short, which is actually bigger than 700,000 barrels short a day in December. So OPEC Plus isn't pumping anything close to what they say they're going to do anyway. So is it really relevant if they say they're going to pump more or pump less? I actually look at what they actually do. I think what the individual.
Are you indicating that they've lost a grip or influence on the market?
No, I think they still influence the market. They especially have the ability to influence prices in the short term just by jawboning it. They certainly can, if they do concerted action, they will influence it. Certainly, if they pumped as much as each of them is capable of, prices would definitely fall. Conversely, they are capable of tightening the market. What I'm saying is that, what they actually say they're going to do and what they actually end up doing are often two quite different things. And the trend is, on their output targets, they're not even getting even remotely close to them. So, the world is getting by right now with with them not meeting their targets. I think what they want to do is they want to see if China actually really does demand more oil and who they buy it from. Because right now the Chinese are sucking up every barrel of Russian crude that they can, just as are India, by the way. Record Russian exports into India in January, much strong into China as well. So what you're really seeing is those two big buyers are basically getting the extra crude that they're wanting. They're getting it from Russia right now at a very big discount. So how does the rest of OPEC need to respond to that? It will be interesting to see. I think, ultimately, if I was picking my sort of black swan for this year, it would be the OPEC Plus group, which should have already had, major inherent conflicts. Those conflicts might actually come to the fore this year. I think, the interests of Russia are certainly diverging from the interests of the rest of the group. And that could be an interesting dynamic. But for this month, next month, probably no changes. I think they're waiting to see if this Chinese demand really does materialize.
And if it does, Clyde, just to follow up on that, is it likely that if you subscribe to the narrative for 2023, that the first half will be, as it is now, relatively oversupplied, but the second half will be tight? Do you expect in that sense, will China go for more oil imports, or will they draw down from their inventories as the need arises in the second half of the year? What has previous performance indicated?
Well, the Chinese have now built up a very large inventory pile. They don't disclose it exactly, but we know that they've probably reached their targets. We know that most of their storage tanks are full. So they've got that ability to draw down on that. Unlike the rest of the world, and which focuses tremendously on US reserves, the Chinese don't talk about it. It's like this huge elephant in the room that no one talks about. What they've done in the past is, if they believe prices have risen too far and too fast, So it's a sort of joint thing there. Then they do tend to tap into their strategic reserve or their commercial inventories and just draw them down a little bit. Whether they have the ability to do that for quite some time. So if they're reopening, if their demand is justifying imports of 11, 12 million barrels a day, but the price goes above 100 barrels, $110 a barrel, then they'll most likely try to reduce their imports back to that sort of 10 million barrel a day level and try and take a little bit of heat out of the pricing. That's what they've done in the past. It's not like, they'll suddenly stop imports altogether or, cut them dramatically, but they'll try to limit them. And you won't really see too much of it. They won't talk about it, but you'll just see in the data that China's actually not importing as much as it used to, or as much as you might think if its economy does rebound.
Well, you would think it's in some ways that the imports of this heavily discounted Iranian, Russian oil into Asia and into China in particular is kind of taking that second half of the year demand spike in oil prices off the table. So this won't be a year of two halves, in my opinion, for the oil market, because the inventories will be so full unless there's some major economic growth somewhere. Henning, I wanted to get your thoughts on that because, of course, you have spent many years living and working in China. The idea of where China's recovery, and I wanted to get your thoughts on two pieces of that. One, your views on the sudden about face on the actual COVID output, the COVID zero COVID policy. It would seem very un-Chinese to make such a radical departure from something like that. And two, whether the Chinese economy can shift quickly to a new dawn. Your thoughts on those two things?
Thank you. It's like question. I didn't actually spend much time in China. Living there was in Singapore, but
right.
On the
you
economy
tracked
in China, I spent a bit of time. No worries. So, I mean, that turnabout in China was dramatic and remarkable. I mean, it took everyone by surprise. So, take Eurasia Group, for example. We had 2022 as the COVID China or zero COVID China would fail as top risk, but that it would, that would fail during the last weeks of the year on that much of a scale. We didn't expect. I actually don't think the Chinese government initially planned to do this, but it clearly shows that even when the world realized that something is happening, unusual is happening in China, that COVID was already rampant and the authorities had no chance of doing much. And then there was some public protests which they feared would escalate, and they just said, "Okay, we need this to."
Can we interpret from this dramatic about face that it could also, that similar posture could appear in other places now? Does one have to include that into your thinking, i.e. they could just wake up tomorrow and radically depart from their relationship with Russia, or they could suddenly love America? I mean, can we now have to include the potential that we can no longer see China as a country in which decisions are slow and predictable?
So we still think China is a power that believes in a form of global order to support its global economy, which is globalized on a scale that Russia's is not. We do still think China will continue in its approach to Russia. In fact, we saw China earlier this week blame the United States for the war in Ukraine and not Russia. And it still has an unchanged policy on Taiwan. So actually, we do think on the global stage, China will continue in its current policy, and it will continue not to like the United States. Now, economically speaking, we do think there will be stimulus. We've already seen it. The Chinese government has said that they will try to stimulate consumption. They will try and reopen China's travel market, which has implications for the oil sector, especially in jet. And this is where we do think, actually, in the second half of the year, we do think there will be a tighter market, because, and part of this is positive. If China's economy fully recovers, that is at least not bearish oil. If Europe escapes recession, which now it looks like it might, it's the same story again. Everyone expected a deep industrial crisis, not happening. And if the United States escapes recession, jury's still out on that, but then you have a similar scenario. And then you have the three biggest oil consumer hubs at the same time actually not going into reverse on oil consumption, but being stable or upward. At the same time, OPEC Clyde already implied this, seems to have quite limited spare capacity to react on the upside. They can cut quite easily, but can they really raise production? And we do expect Russian production to start declining towards the middle of this year because of the exodus of international companies and tightening sanctions regime. So if that all falls into one place towards the middle of the year, we do see a tighter market
for the second half.
But that would half of that would be positive because it would be avoiding recessions in most of the world. So if you have high,
let's get a view on that from South America before we get this. First, have the survey question. Jose, the other big question is, what impact will an OPEC plus rollover of existing supply have on oil markets? The expectation is a rollover. That's no surprise there, but will it be bullish or bearish or no impact for oil markets today, this week? Jose, the other big decision today, of course, is the Federal Reserve raising interest rates. Again, it seems to be a foregone conclusion. It's going to be higher by a quarter, 25 basis points, but moving towards, the highest level in almost 15 years. And why we're seeing very serious stress among some Asian developing countries, Pakistan, Sri Lanka, others under the weight of a stronger dollar, the weight of more expensive dollar-denominated debt. Are there any countries in South and Latin America, like Venezuela, of course, always at the doorstep of duress, unfortunately, that are vulnerable to this rising rate structure in the US, where dollar-denominated debt could become a problem?
Yeah, well, I think the majority of the South American countries have been, they have traditional problems against the dollar. When this different decision and when a strong dollar scenario happens, as most of the regional currencies have been facing different stress, like the Argentinian peso, for example, just like the Bolivar or the Colombian peso, or in Bolivia or in Peru. I mean, all these different currencies have been facing different problems and different, depreciation against the dollar because of this, because the traditional bilateral relationship between the U.S. and the region, and because of the dollar predominancy in the commodities markets and trading. So yes, I believe that there's a relationship and there will be still problems in the regional currencies if this scenario of still strong dollar continues.
Clyde, if you could just wrap us up with Australia data overnight showing that house prices falling for the 9th straight month. That's along with a lot of the world, including Chinese house sales, dropped 30% year on year in the fourth quarter. Your thoughts on the rate rising cycle as it comes to near peak? Apparently, according to most forecasts, it is the Fed and most of the major central banks of the world. We're getting to peak rates. Its impact for the Asian vulnerable states.
I think the biggest risk is, central banks have actually a fairly poor record when it comes to managing that sort of soft landing. They tend to over tighten, and you end up with a sort of harder than necessary landing. I think that's a tremendous risk around Asia, and it's not one that people are really looking at that much. I mean, you're starting to see a lot of activity indicators, slow quite quickly. South Korean exports, it's not just housing prices and things like that. So I think there's more risk there than people are really factoring in. Everyone's focused on this China reopening and not really on the fact that, high interest rates do work. They do cut activity. They do stop buying. They do stop consumer spending. They stop a whole range of things. They are starting to work, and we're starting to see it. And, the high interest rates, while we might not see much more added on top, the rate hikes we've already had, the full impact of them is still to come through. And that's clearly not a positive. And I think it's something that people are just, they're just looking at the China elephant and ignoring all the little sort of wildebeests running around.
And maybe that's why Brent crude oil is struggling to move away from $85, where there's a lot of bullish signs, as you indicate, optimism around China, but ultimately there isn't enough wind. There's enough drag, perhaps, from this economic, although the IMF have upgraded its forecast for the year to 2.9% on the global level, that there's still enough drag on the macro picture to keep oil prices, although very nicely in the $85 barrel range, you would say. I don't think any country in the region where I'm sitting, which sells a lot of the stuff every day, will be too disappointed with where prices are at, and hence why they're not going to do anything to raise any noise today when the OPEC Plus meeting takes place. And according to our poll, at least, having no impact on the markets. I'm sure OPEC Plus will be happy with that today. Thank you, everybody. Thank you so much, Henning. As always, Clyde and Jose, really appreciate you guys engaging. And I know where some of you are is early doors and very late, perhaps, in Venezuela, but we do appreciate that. Thank you. Have a good day, everyone.
Thank you.
Thank you.